There has been a massive dumping in the United States. And I'm not talking about the bullshit that's coming out of Trump's mouth. I'm talking about investors that are leaving and moving their money, both Canadians going out of the US and also foreign investors. And they've been putting that money back in Canada. What effect is that going to be having on our side and on our mortgages? Well, we've talked a lot about variable. And if you've been tracking, I am batting 1,000 on the overnight lending rate adjustments with Prime, of course, coming down again last week. We have still the steak dinner guarantee. I'll be sending out the forecast again in April. And so much as the guarantee goes, if Prime goes down another quarter point, I guarantee you that I will be having a steak dinner. That's the steak dinner guarantee. Anyways, I'm James Lowen. Let's get into some more information on what's happening in the bond market and what that's going to potentially mean for Canadian bonds. And what does that mean for Canadian fixed mortgage rates? Because that's where I'm going with this one. So let's get going. I'm going to shrink my massive head down as usual. And we've got this article coming out showing that the foreign investors are dumping US stocks and pouring billions into Canadian bonds. And this is big. This is actually going to make somewhat of an effect in our markets here. So how much are we talking about? Well, according to Statistics Canada, on and on, investors poured about 33.5 billion into Canadian bonds, with more than half of that going into US dollar denominated debt. This is massive, most since April 2022. So we're not talking about just like some millions here. This is huge amounts of money that are coming into it. So the shift in investments resulted in a net inflow of 11.1 into the Canadian economy. That's massive for us, all right? And what effect is this going to have on our Canadian mortgage rates? Well, we've talked in the past that variable mortgages control, of course, so Prime controls variable mortgages, and that bond yields determine fixed rate mortgages. Higher demand for bonds typically lowers bond yields, all right, as bond prices basically rise. And so the more that we have all this capital inflow going in, this is basically going to lower borrowing costs for governments and corporations. This might increase liquidity in the Canadian bond market and keep yields basically in check. So all this to say, with fixed rate mortgages being closely tied to the bonds, particularly the 5-year government of Canada bond, if we're seeing this happen and those yields remain low, then the lenders in Canada, i.e. the banks and such, might adjust their fixed mortgage rates even lower. So we've been seeing for a high ratio or insured mortgages, we saw a couple weeks ago come down to 3.99 for a 5-year fixed. It's possible then, after with all this pouring, now keep in mind this is going to take, there's always a lead and lag, so it's not like this is going to happen tomorrow, but all likelihood we're probably going to see the 5-year bond for conventional lending as well, so meaning more than 20% down, also go below 3.99, which is huge. Definitely what we need in the spring market, definitely what we also are going to be celebrating amidst this tariff anxiety period, or uncertainty as we might call it. So all that to say, great news for people that are looking to get into the market, looking to buy or upgrade. We have a massive amount of people that are believing, we believe that Canada is a pretty awesome place to be and invest in, as we see as well. If you're holding in the US markets, I'm sorry, you're probably experiencing a little bit of a low or a little bit of drag on some of our US stocks, but in Canada, that's great news. And we're going to celebrate this potential lowering on the 5-year bond yields and fixed rate side. So I'm James Lowen. You've got your bond yield information going. Have yourself a fantastic week. And here we come for even lower rates. Ciao for now.